And we are back in the building. Day 6 has arrived. And ladies and gentlemen, I think I'm starting to figure out a flow of how I want to structure this thing. And I was trying to find a way to encompass both the price action stuff and the psychology and all the intangibles, but I didn't necessarily want to teach you all the price action stuff first and then hit you with the mindset right at the end, because what's going to happen is a lot of you guys are going to just get the price action concepts and then you're going to stop watching the boot camp. You're going to go out there and try to gamble, and you're just going to be caught in the same loop. And it's going to be very hard to catch up to the boot camp after that if you've decided to walk away from it. So in order to mitigate this while still delivering you guys all the concepts as we go, I'm going to have a price action lesson / strategy and, market structure, all of this stuff, order flow. And then every other day, we're going to throw in some psychology, some discipline, some mindset, and just behavioral change, like how to actually change your behavior on the charts. Because the only difference between me and you, especially if you're already trading a strategy, we may be using the same strategy. We may be looking at the same order block or the same fair value gap. So why is it that I'm profitable and you are not? Well, it's because of behavior. Trading is not about information. It's about behavior. You're probably closing positions early before they can run. Maybe you get shaken out of your position, so you take a loss and then it goes your way. Maybe you're just chasing trades. Maybe when you take a loss, you chase the loss, and I don't. So is there a difference in strategy there? No. It's a difference in behavior. It's a difference in how you perceive and respond to outcomes, which we'll get deeper into. But today is a price action lesson, ladies and gentlemen. So if you've been excited about price action, if you've been watching these videos and wondering when I'm going to get to price action, well, today we're going to be talking about market structure. Now, market structure, what exactly is market structure? Well, it's how we can tell which way the market is going. The market can only go 3 ways: up, down, or sideways. And how do we put a more specific name to these directions? Well, first off, if the market's going up, this is bullish structure. What is bullish structure? It's when price makes higher highs and higher lows. So you can see here, price started down here. We made a higher high, higher low, higher high, higher low, and so on and so forth until the bullish trend is over. Now, on the contrary, we have bearish structure. And bearish structure is simply where you make a lower high. And bearish structure is where you simply start up here. You make a low, you make a lower high, you make a lower low, lower high, lower low, and so on and so forth. So you're seeing these points in price where it's almost like a stair step up and a stair step down. Now, obviously, it doesn't go perfectly this way. You're not going to get one singular high right here, one singular low right there. We're going to jump on the charts and show you how to actually identify this when price isn't exactly moving in a straight line up and down in these exact proportions. So, but before we do that, we got to cover the third way price moves, which is consolidation, or in other words, ranging. We're stuck inside of a range and we're not making any significant highs or lows or significant closes outside of this range. If you remember from the last price action lesson, wicks do the damage, bodies tell a story. In consolidation, the bodies, you'll often see them closing side by side in a consolidation. So let's go ahead and hop on the charts and start to identify some of these things. So you can see here, price for quite a bit of time this week was going bullish. Now, of course, there's going to be somebody in the comments asking, well, we made a higher high up here, but there was a lower low down there, and then we decided to go sideways, and then, we came down here, and then it's a higher high. So is this a bullish trend or a bearish trend? Well, we have to look at the overall direction, guys. If you take a look at this chart and from here to here, you were to tell me which way it went the majority of the time, it would be bullish, correct? We are moving in a similar pattern as we just drew out on that chart. Now, of course, it's not going to be exact, but the general direction is still up. Just like if you took this particular segment of price between maybe here and here, you would probably say that this small window of price from this leg to this leg is bearish, because this is starting up here. We made a low, higher low, lower low, higher low, lower low. And we're making a whole bunch of lows and highs in there, but the general direction is lower. So that is bearish structure. Now, on the contrary, let me focus your attention to this price right here. Now, what is this doing right here? This little section of candles. Where are we moving, guys? Are we moving in any obvious direction? Like if you had to bet $1 million on this particular piece of price right here, would you be able to tell me which direction it's mainly likely to go simply by looking at this little fractal right here? Probably not, right? Because the candles are literally closing side by side. So this is a dead giveaway of consolidation profile, guys. And I know we haven't got too much into lower time frame price action yet, but even if you just drop to the 5 minute, it's just going back and forth, guys. And if you go drop to the 1 minute, you know, of course, we're making spikes here and there, but overall, we're staying in this general vicinity. So that is a consolidation. So as long as you understand the basics of that, we're going to get much deeper into it, much more granular, but this is just the start of your understanding of price action. So whenever you're looking at your charts, mainly when you're looking at your session, you want to be looking back at the previous session and seeing what type of structure we made, because that's going to have an influence in your session. And we're going to show you exactly how to do that as well in a future lesson. But just so you guys get it, bullish structure, bearish structure, consolidation. Now, let's go back to the slides, guys, because we have other concepts to cover as well. Getting a little bit more granular, but not too much to confuse you. These are all of the different ways within these structures that you see that price is going to move. So we have consolidation, we have expansion, we have retracement, and we have reversal. And this might remind you of the power of three that we talked about: accumulation, manipulation, distribution, except this is a little bit more specific, and I'm going to show you exactly how to do this with your session, and it's going to make a lot more sense why you even need to know any of this shit. But consolidation, expansion, retracement, price is always moving from one of these phases. So you see here, consolidation, moving side by side. Guys, all moves in the market start from some form of consolidation. The smart money is building orders on both sides. They take one side of it and then they run in the actual direction. And if you studied any bit of ICT, you probably understand this concept, but just know all moves start from some form of consolidation. And after we do that, of course, we manipulated and we started distributing, otherwise known as expansion. Honestly, those two terms are pretty interchangeable, as well as accumulation and consolidation. Those two terms are pretty interchangeable as well. So just so you know that I'm not talking about 1,000 different things here, guys. And it'll make a lot more sense when we hop on the charts. And then retracement. Retracement happens after expansion, guys, because price never just moves in a straight line forever and continues to go up, and never moves down in a straight line forever and just goes down for eternity. There's always going to be expansion, retracement, expansion, retracement. Think of it as like a runner. Like if you're running long distance, or, you know, like think of it as a workout. Like if you're going hard, you're going intense, you got to rest. Just like that, price has to rest. Price has to be efficient. Price has to give smart money discounts, which is another thing we'll talk about. But essentially, price needs a little breather, so it goes back to take a rest, and then it's like, okay, I'm ready to go up now. So that is retracement. And then, of course, we have reversal. So how do you tell when price is going to stop going in a certain direction and reverse? That is where you learn the concept of reversals. So these are the 4 things that you're always going to see price do, and I'm going to prove it to you right now on the charts. So in order to make this example more relevant, let's go ahead and rewind to the AM session. I don't even know which freaking day this is. Okay, I guess this was Tuesday. So yesterday on Tuesday, you can see 9:30 open was right here. And where were we going at 9:30 open? Well, if we were studying this fractal of price before 9:30 open, we were going down at this point. So price went all the way down here. And then what do? We reversed. So this would be a reversal. This is a New York reversal, you guys. And you're going to understand a lot more what that means. But just so you see, that was a reversal. So that right there, we're going to highlight that. Price was moving in one direction, started going the other. That right there is a reversal. And just so you know, guys, I'm not going to have a bunch of cuts and, jump cuts where it just marks the lines on the chart and they just teleport here automatically. This is slow, methodical teaching. And then you guys are actually going to see how I draw out all this stuff and label and all of that good stuff. So if you want the flashy videos that are like 2 minutes long and, just cut straight to the point, this is not the place. This is a place where you really deepen your understanding, going over several examples, not just one or two, like in these guru videos. So, price opens. We were going down before market open. Let me make this a little darker because I know on OBS it's not really showing that dark. So let me see what color we could put this on. Boom. Is that a better color right there? All right, we'll just do that. All right, so you can see that line pretty clearly, I hope. My goodness. All right, now you should be able to see it. All right, so you can see that before New York open at 9:30. We were going down, and then we started to go up. So that is a reversal. Now, moving on. After that reversal, what did we have? We had a little bit of consolidation, but we also had a retracement. So from that reversal, of course, we had a little bit of a retracement. We retraced here to this order block. And then slowly but surely, we started to expand up. So this is pretty much just like a consolidation here. Then we retrace, then we expand, we retrace again, and then we expand. So sometimes, guys, this is going to deliver very smoothly. See that expansion right there? That's a very high volume expansion. That expansion right there is very big as well. These expansions are like very weak, which usually happens at the top of a move, but eventually we do find our momentum again. We expand, we consolidate / retrace, then we expand again, retrace into that fair value gap, and then we expand again, we consolidate at the top, and then what do? We start to retrace. So price retraces, and then where does it go? It goes up, and then it gets stuck and starts consolidating, and now it looks like price is going to start reversing. And look at that. We have a reversal. And in that reversal, what do we have? We have retracement, expansion, retracement, expansion, and then we start to do a bit of consolidation. And then we reverse again. So these particular days are a little bit more consolidation bound. So whenever you see candles just like closing back and forth a lot versus like over here, you guys, you can see that it's very smooth throughout this move here, very smooth throughout this bullish move up here. Sometimes price is going to be very loose and smooth and easy to read. It is FOMC week right now, guys. So classically during FOMC week, you'll see a lot more consolidation. And it's pretty obvious when you look at it here. But let's go ahead and move to another 9:30 a.m. session. Here's another 9:30 a.m. session. And what were we doing at the start of that session? Well, we were pretty much just consolidating, guys. So price was in this general vicinity. We had an expansion right here from London session and the bearish direction. So that was an expansion. And then we started to retrace right there. So this move right here is a retracement. And then we tried to expand down again, but we kind of got stuck. And then in between that, guys, what is that? That's a bit of consolidation right there, isn't it? And then over here, what do we have as well? A little bit of consolidation within this zone. And now that's more of like a consolidated retracement And then this is like consolidating right here as well. So let's see what happens going into market open. But this is typically a day where I'd probably avoid it just because of how uncertain price is looking. And we do end up expanding in the bullish direction. So you can see we expand there. Now, there is a bit more context to this, guys. So if you're a little bit more advanced and you're watching this, you're like, bro, show them that there's the market structure shift right there that left a fair value gap, and there's the order block, and there was probably a higher time frame sweep that we did, and then it was New York session reversal. Okay, bro, we get it. We get it. You know a lot about price action, but you're still not profitable. And that's a lot of traders out there. So let's not get ahead of ourselves, guys. Let's learn the basics. I'm just really cherry picking basics of individual concepts. So I'm not telling you to go in tomorrow and risk your house on this by just knowing these concepts. We have not even got to how to place an entry yet. So slow your roll, guys. We're just talking about expansion, consolidation, retracement, and reversal. But you can see expansion through New York session right there. And then what do we do, guys? Looks like we do a bit of retracing, a little bit of consolidating, and then ultimately we end up going down in the other direction. So right here, guys, this would be a retracement. So price tried to retrace, but was unable to continue the bullish direction up. So the move kind of slowly faded out. We started consolidating here, and then eventually when the new day opened, we gapped down. So you can see ultimately this ended up being a reversal, but if you were simply looking at 9:30 a.m. to 11 a.m., and now we're getting more into how to apply this to your session, you could see that this was simply expansion. So today during New York simply expanded, and it reversed on the trend from London session. So again, guys, New York reversal, you're going to learn about that profile, but you can see here, we're using the concepts we just learned to understand. And what did I tell you guys? All moves start from some form of consolidation. What is this right here? And then this just area of price in general, it's pretty consolidated for the most part. It's not just making higher highs and higher lows real clean, real fast, real nice. So let's jump back to another day as well. So what would be exactly a day from now? 9:30, and then we'll mark it out till 11 a.m. as well. So you can see this little window right here. And what did we do in this session as well, guys? We expanded. But if you zoom out, we were actually retracing because during London, we had made a bullish move up. So depending on how you want to look at this, you could either say we were retracing from London, or you could say that we were expanding from 9:30 a.m. to 1 a.m. Well, or no, from 9:30 a.m. till 10 a.m., we were technically expanding in a bearish direction, but from a macro perspective, we were retracing on a bullish move, right? The biggest price leg from that day up until then was from London. So we made a bullish trend throughout London. What is New York continuation profile? When we retrace into New York and we continue in the direction. And you can see it's very slow to ultimately continue in that direction. But honestly, guys, you only need it from down here to up here to catch plenty, guys. If you're using my top and bottom tick model, that is probably like an 8R or a 9R or 7R or something crazy like that. But you can see in this particular case, we retraced during New York. So whenever you're looking for a New York continuation profile, or you're looking for your New York session to continue the trend from London, what you're really looking for at a core level, and this is where I'm going to blow your guys' mind, what you're really looking at from a core level is you're looking to see into your session. So let's say 9:30 was right here, guys. You're looking to see expansion into New York session. So this is 9:30. This red line represents the same red line that we were drawing in our example here, guys. So let's go ahead and rewind just so you guys are very, very, very clear on what I'm telling you. So let's take this from over here because we're done with this one. And you can see that we made an expansion. So we have an expansion here from London. So what you want to see in New York continuation is you want to see that going into New York and from London, we had made an expansion. And what is that going to tell you? It means that after 9:30 opens, price can now retrace and continue. And you're trying to catch it right there on a continuation profile. Because if you position yourself right there, you get to ride this whole move, versus if you position up here, you're in drawdown, right? If you position like up here at the top, you're also in drawdown. And if you position anywhere over here, it's before your session, so it's irrelevant. So the most optimal position would be right here. So let's see what happens over in our real example. So you can see price had expanded. New York Open is here, and we're anticipating bullish continuation after the retracement. So what do? We wait for the retracement. Boom. What is this window of time? Let's not get too past the window of time. But where would you be looking to enter? Boom! Right down there, guys. Wasn't that exactly what I just showed you on that other chart? You know what I mean? So that is how you actually apply this stuff to your session. Now let's take a look at one more example here, just because I really want to drive this point home and make sure you guys understand this fully. And I'm not selecting these days on purpose either, guys. I barely traded all week, so this is literally just me marking out what I'm seeing on this chart right now. So in this one, you could see New York, and this is where it gets nuanced, guys. Like I said, price is never just going to literally move exactly like this and look like a line chart. I mean, sometimes it will, but if you're only able to read price when it's like that, then you're going to get very, very confused. So it's important that I teach you guys nuance. So before New York Open, what did we have? Well, if we zoom in, you guys, we had an expansion. This is an expansion here. And if you don't know what a fair value gap is, do not worry, but I'm just going to draw this out to drive the point home. We're going to get into fair value gaps, so don't go out and try to take entries with this yet. But price expanded into New York. Our goal is to catch the retracement. So what would that look like? It would be like boom, boom, boom. We're going back, and then we go up. So that's what we're looking for, right, guys? And now what happens off of New York Open? Let's see here. And boom, we retrace into that fair value gap. You can see the wick right there. We drive into that gap. And then where do we go after that? We decide to expand again. So if you would have positioned yourself somewhere down here from the retracement, you would have rode that move up. And if I drop down to the 5-minute, you could see a lot clearer that retracement, and then we go up. So if it's starting to tie together, if you're like, oh, I see what's happening now, then this is working, guys. So let's go ahead and look back at this example. You could see that's exactly what we did. And what is this? I didn't draw this here on accident, guys. That is a fair value gap as well. And we'll get into what that means later, so don't worry about it too much, but I'm just driving that point home that we just studied that on the line chart, and we just saw it happen twice in price. So that is how you guys tell basically what's going to happen before going into your session. Of course, it's just a initial analysis. It doesn't have to go that way, but we're going to give you a bunch of other skills in terms of like higher time frame bias, London low and London high, time-based liquidity. And these are all ways that you can begin to answer the question, you know, that's great. You show me how to catch the retracement into expansion, but how do I know when it's going to reverse? You didn't teach me when it's going to reverse. Well, guys, it's a little bit more of an advanced concept that requires more understanding of the higher time frames and how all of these time frames work together in terms of like time and price. But we're going to get much, much deeper into that. So that is market structure at a base level. Before we leave here, I'm going to teach you one last concept about basic market structure. So let's go ahead and go to the next slide here. And the last thing is swing points, guys. So you've probably heard the term swing high, swing low. If you don't know exactly the technical definition, it's when we have a low, so we have a low down here with a higher low to the left and a higher low to the right. So you can see this is the lowest low that was made. To the left and to the right, there are higher lows. So this is a swing low, indicating that price could potentially move higher or is putting in a low. Now, a swing high is just the opposite. It's a bearish swing point. It's when we have a high, so the highest high is up here, and then to the left and to the right is lower highs. Pretty basic. Gets a lot more nuanced than that, and we'll dive into that in a future lesson. There's intermediate term lows, there's long-term lows, there's rebalanced lows and highs, there's, London high, London low, which is something we'll get into like very soon. New York high, New York low, Asia high, Asia low. So we'll get into all that very soon, but just know that this is swing points. And why is this important? Why do we need to know about swing points? Well, swing lows and swing highs are where buy stops and sell stops cluster. And where stops cluster, liquidity resides. If you've heard of a liquidity sweep, if you heard of buy side liquidity or sell side liquidity, this is all terms that have to do with buy stops and sell stops being at certain levels. Where do most people put their buy stops and sell stops? At swing highs and at swing lows. So let's go on to the charts again. And we're going to go ahead and point out some of these examples. And it looks like I got one marked out already here. To the left, lower high to the left, sorry, and then lower high to the right. So that is a swing high up there. And you can see that price starts to move down. Of course, that's not the exact reason why it moved down, just because there's a swing high there, but it indicates that a high has been put in. And just like over here, we have a swing low. So we have a low down here. What's to the left of it? Higher low. To the right of it, higher low. Pretty simple, right? Swing highs and swing lows. Now, what I want you to do, guys, is I want you to go through and mark out the New York session just like I did. Go through the entire past week of price action, or as far back as you can possibly manage to do. The more examples you have, the better, but just solely hone in on this small window of price and see if you can identify all the things we covered. So the market structure with the bullish structure, bearish structure, consolidation, see if you can identify that. And then taking it a step further, see if you can start, doing what I did with at least the continuation or consolidation. Don't worry about reversal too much yet. You can label when it happens, but don't worry about too much of like why it happened or how can I catch an entry with it and stuff like that. Like, guys, we shouldn't be focused on entries right now. You don't even have enough knowledge to start risking money. So identify these as well. And then, of course, mark out swing highs and swing lows. And we're not going to get too much into liquidity until the next price action lesson. But if you want to, you can also start marking out these swing highs and swing lows. So in other words, if you identify a swing high up here, boom, can mark it out. And then if you identify, let's say, a swing low right here, boom, you can mark it out as well. And you can start to identify how price acts from these levels, and you can start studying if it like respects them or not. Obviously, this one didn't get respected, and there's a way to like identify the highest probability levels of liquidity. That way you're not just marking every single level. So if I were to just sit here and just be like, oh, that's a swing high. This could technically be a swing high on the 30-second, and then this could technically be another swing low right here. And then we got another swing low down here. And then like some of your guys' charts literally look like this. And this is what I used to do too, bro. I used to like literally mark every level because I was scared that I was going to miss a level. I'm like, oh my gosh, I don't know which one it's going to deliver from. So I might as well just mark them all and mark them all and mark them all. And then you have no idea what's going on. There's too many lines on the chart. So we're going to get into how to like identify the most important levels of liquidity. But for now, just worry about identifying the swing highs and the swing lows. And then if you happen to see like a high or a low get respected or get used for like a sweep or something, maybe just mark that out. And then later, when we learn other lessons, you can start to put the 2 and 2 together. But for now, I would just keep it at that. Gather some examples of all this stuff, guys, and make sure it's relevant to your actual session as well. So this is your assignment. Mark out the last week of price action, narrow out your windows like I was doing with the vertical lines, and annotate where you see these concepts playing out. Appreciate you guys being here. We got another psychology lesson coming tomorrow, following that up, we're going to talk about time-based liquidity. So appreciate the dedication, guys. Literally, one of you stayed up past your bedtime last night just to catch the lesson. So that is just amazing, guys. Like, that's dedication right there. And just know I do not take that shit lightly. Like, that makes me want to go even harder and value pack this shit even more. So I'm not saying that I'm going to drop at the same time every night. My schedule is very crazy, but I do promise at least one lesson every single day. So much love, guys. God bless you. Appreciate you being here. And I will see you all in the next lesson. Peace.